typically what guys do is they go and build a strategy, test it, and then run a parameter optimization on their strategy. And then they'll go ahead and select a single set of parameters and go and trade. And I found that approach is flawed and subject to all sorts of good and bad luck. And so oftentimes you may well predict the optimal parameter, but likely not, because they don't tend to be stable through time. And so what I found is far more effective.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi, it's Andrew Swanscott here, and welcome to Better System Trader. This is episode number 81. Well, one of the main challenges with mean reversion trading is deciding when to get into a trade. How far from the mean should you actually wait before you consider actually getting into a trade? Now, when you're in a trending environment where the dips are shallow, getting in close to the mean can bring you lots of trading opportunities, which can perhaps translate into more profits. However, when market conditions change, that approach can be a recipe for some big losses, or at least some heavy drawdowns, open drawdowns, by getting in too early. Now, mean reversion traders can often experience a great run with lots of small wins, only to see them get wiped out pretty quickly, often in just a few big losses. And this has definitely happened to me in the past, especially in my stock trading, and I'm sure there are lots of other traders that are listening and nodding their heads with me too. In fact, I received an email about this exact challenge from a listener called Simon a few weeks back, and he was... Actually, I might just read you a small bit of the email. I have it here on my screen. Simon says, I have a stock trading mean reversion model that has all the right ingredients, great risk-adjusted performance, incredible consistency, very large sample sizes for testing, simplicity, etc. The one issue that I'm trying to improve is the nasty drawdowns which occur naturally when trading correlated contracts, that is stocks, all moving south together. As you'd know, all available positions get sucked into these down moves, compounding the issue. Simple stops don't seem to be the answer based on their overall impact on the system. And then Simon goes on to say, a couple of things that I'm trying, sometimes in combination and with some success. The first one is throttling the number of positions that can be triggered per day, effectively spreading the risk over the down move. The second point is critical model stop and wait functionality when drawdown increases. And then the third idea he is testing is market regime-based methods of throttling or stopping new entries. Now, all three of these options are quite popular techniques that could help to reduce drawdown, but there is another idea which PJ Sutherland shared with us back in episode 62 of the podcast, which I thought was quite interesting, and that was this idea of trading the mean reversion curve. Let's take a quick listen to PJ explaining this concept, because it has a number of potential benefits, and we'll see how it could possibly help in this type of a situation. So over to PJ. Yeah, and I think another challenge of mean reversion is knowing when to enter as far as the distance from the mean, because you never really know how far it's going to go before it reverts, and sometimes it doesn't revert at all. So how do you get around those challenges of knowing or determining how far from the mean before you look to enter?
To combat that, I've done a lot of interesting work around, so typically what guys do is they go and build a strategy, test it, and then run an parameter optimization on their strategy. And then they'll go ahead and select a single set of parameters and go and trade. And I found that approach is flawed and subject to all sorts of good and bad luck. And so oftentimes you may well predict the optimal parameter, but likely not, because they don't tend to be stable through time. You go out and trade it, and if you had a good run, wow, that's fantastic. You might think you're very clever and increase position size, etc. But if you have a bad run, it might just be too bad luck. And so what I found is far more effective, and I actually picked this up reading an unlikely book that was written by Tony Robbins. He wrote a book on, I think it's called Mastering Money. And he had actually a great book. And he had this segment on Ray Dalio, who founded Bridgewater Associates, one of the largest hedge funds. And Ray learned early on that it was a futile endeavor attempting to predict future market environments. And so what he and his team did for almost 2 decades was try to construct a portfolio which he called the all-weather portfolio that would have a piece for each environment. So it didn't matter whether, what environment we're in, we'd be performing. And so that kind of just struck a chord with me. And I went away and started applying that to our own trading. As you correctly pointed out, specific to mean reversion is we never know ahead of time when the reversion is going to start. Is it going to start today, tomorrow, 10, 20, 30%? And likewise, we actually also never know when the recovery will end. Will it be a week, 2 weeks, 3 weeks, etc.? And so what I was doing originally in my trading is just picking a single set of parameters, which would be entering either shallow, deeper down, and a single set of parameters in the exit, and often being quite disappointed with the strong deviations in life performance relative to the back-tested performance. And so the concept here is instead of making 100% allocation to a single mean reversion strategy, and this is regardless of whether your strategy is highly adaptive and normalized and all the other things, volatility can expand a lot quicker than any indicator can keep up with. And so it still always makes sense to pursue this approach, because obviously a counter argument would be, well, why can't we build a single indicator that can allow for all this? But the truth is volatility can expand a lot quicker than our indicators can adjust. And so it makes sense then to iterate across a very broad spectrum of parameters. And for instance, if we use very simply our rate of change, a 4-day rate of change, one entry would be stocks lost 1% from 4 days ago. Another would be 3%, 5, 20, all the way down to 30%, whatever the case may be. And likewise, on the exit, we could decide to exit once we've gained 2%, 3%, whatever the case may be. And so I started to iterate across what I call the mean reversion curve. So I build strategies that are tremendously robust and that have entries across that entire entry curve and exits on the exit side. And so instead of allocating to a single set of parameters, we'd go in then and I've construct an algorithm that does this automatically for clients in Quant Lab. So literally click a button and it would put together 30 or 40 strategies that are now diversified across the entire curve. So instead of making an otherwise 100% allocation to single parameter combination, we'd be doing 5, 3%, whatever the case may be. And since we deployed that, we've seen really some phenomenal performance. We're now achieving an average result through time and are much less susceptible to the effects of luck. In fact, if you do it correctly with a large enough account, you almost completely eliminate luck. And one of the big payoffs is you start to see performance that very closely resembles that of the tests.
PJ's suggestion to stagger the entries and exits across the mean reversion curve kind of removes the how far from the mean question, and as he explained, it reduces the impact of luck on returns. It can provide performance that more closely resembles back-tested results. And there are a couple of other benefits in there too, but my mind has just gone blank. But now this idea doesn't just apply to mean reversion trading either, though. Back in episode 17, Jerry Parker also mentioned a similar approach where he staggers the entries and exits in his trend-following futures trading. So this type of idea can also be applied to trend-following approaches as well. Now, obviously, this approach could be difficult to apply with a small trading account, or perhaps not, depending on what and how you trade. But I think it's an interesting concept to consider and definitely worthy of some testing. And perhaps it can also reduce the drawdowns in Simon's strategy too. Anyway, that's it for this episode. I'll catch you again in a few days' time where I've got a new guest and I'm sure you'll enjoy. So enjoy the rest of your week and thanks for listening to Better System Trader.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.